Investing for the first time can be an exciting yet overwhelming experience, especially in the dynamic Australian market. I remember when I first started investing, I was eager to jump in and make a killing. But guess what? I made a ton of mistakes. I'm talking about the kind of mistakes that cost you serious cash. I lost about $70,000 so far. Let me tell you, I learned my lesson the hard way. In this video, I'm going to walk you through the 10 most common mistakes that first-time investors make, so you can avoid the financial pitfalls that I fell into. Alright, let's dive right into the first mistake, jumping into investments without doing your homework. Look, I get it. Investing can seem complicated, and who has the time to read through pages and pages of financial reports, right? But here's the thing, you wouldn't buy a house without getting it inspected first, would you? The same goes for investing. You need to know what you're getting yourself into. Before you even think about putting your hard-earned money on the line, take the time to understand the market. Look at historical trends, research different asset classes like property or shares, and understand how economic factors can impact your investments. There are tons of resources available online, from reputable financial websites to government publications. Trust me, a little bit of research goes a long way. This next mistake is a big one, folks. Not setting clear financial goals. It's like setting out on a road trip without a destination in mind. You might enjoy the ride, but you'll never actually get where you want to go. Are you saving for a down payment on your dream home? Planning for a comfortable retirement? Or maybe you're looking to build wealth for future generations. Whatever your financial aspirations, write them down and make them specific, measurable, achievable, relevant, and time-bound. Once you have your goals in place, you can tailor your investment strategy to align with your timeline and risk tolerance. Remember, investing without goals is like shooting arrows in the dark. You might get lucky, but it's not a sustainable strategy for long-term success. Alright, let's talk about something that many first-time investors tend to overlook, the hidden costs of investing. It's easy to get caught up in the potential returns, but remember, every investment comes with its own set of expenses. We're talking about things like brokerage fees, transaction costs, and annual management fees. These costs can eat into your profits if you're not careful. Before you hit that buy button, make sure you have a clear understanding of all the costs involved, so you can make informed decisions and protect your hard-earned money. Mistake number 4, emotional decision-making. This next mistake is a real killer, letting your emotions dictate your investment decisions. We've all been there, right? You hear about a hot stock tip at a barbecue, or you see a cryptocurrency skyrocketing on your newsfeed, and suddenly you're feeling the fear of missing out. But here's the thing. Investing based on emotions is like trying to steer a ship in a hurricane. When you let fear and greed cloud your judgment, you're more likely to make impulsive decisions that you'll later regret. Remember, investing is a marathon, not a sprint. So next time you're about to make an investment decision, take a step back, take a deep breath, and ask yourself, am I letting my emotions get the best of me? Mistake number 5, failing to diversify. Let's talk about diversification, or rather, the lack thereof. One of the biggest mistakes I see first-time investors make is putting all their eggs in one basket. They find an investment they like, maybe it's a single stock or a property in a specific neighborhood, and they go all in. But here's the thing, diversification is key to managing risk. If you spread your investments across different asset classes, industries, and geographical locations, you're less likely to be wiped out by a single event. Don't put all your eggs in one basket. Spread your investments around and give yourself the best chance of success. Mistake number 6, timing the market. Alright, let's talk about a mistake that even seasoned investors struggle with. Trying to time the market. You know what I'm talking about. Trying to predict the perfect time to buy low and sell high. The market is influenced by a complex interplay of factors, from economic data to geopolitical events, and it's virtually impossible to consistently predict its movements. Instead of trying to time the market, focus on time in the market. Adopt a long-term investment strategy, like dollar-cost averaging, where you invest a fixed amount of money at regular intervals, regardless of market fluctuations. Mistake number 7. Neglecting professional advice. You know, I get it. We live in the age of information overload. Seeking professional advice from a qualified financial advisor can be invaluable, especially for first-time investors. A good advisor can help you create a personalized financial plan, choose investments that align with your goals and risk tolerance, and navigate the complexities of the financial world. A good advisor can save you money in the long run by helping you avoid costly mistakes and make informed investment decisions. Mistake number 8. Not understanding legal obligations. All right, let's talk about something that might not be the most exciting part of investing, but it's crucial nonetheless. Understanding your legal obligations. Look, investing isn't just about picking stocks and watching your money grow. It also involves navigating a complex web of rules, regulations, and legal requirements. Failing to understand these legal obligations can lead to costly disputes, fines, and even legal action. Take the time to educate yourself on the legal aspects of investing or consult with a legal professional to ensure you're on the right side of the law. Mistake number 9. Chasing trends. This next mistake is a classic: chasing trends. You know how it goes. You see a particular asset class or investment strategy blowing up in the news. Everyone's talking about it, and you feel like you're missing out if you don't jump on the bandwagon. But here's the thing: trends come and go. Chasing trends is a recipe for disaster because you're essentially buying high and selling low, the opposite of what you want to do. Do your research, understand the underlying value of an investment, and invest in assets that align with your long-term goals. Mistake number 10. Underestimating the importance of patience. All right, let's wrap things up with a mistake that's all too common, especially among first-time investors: underestimating the importance of patience. Look, I get it. We live in a world of instant gratification. We want to see results, and we want to see them now. But here's the thing: investing is a long game. It's not about getting rich quick. It's about building wealth gradually over time. The key is to stay the course, ride out the volatility, and let the power of compounding work its magic. Remember, patience is not only a virtue, it's a necessity when it comes to successful investing. Avoid these mistakes I made and invest with confidence. So there you have it, the top 10 mistakes that first-time investors make. Look, I've been there. I've made these mistakes myself, lost money, and I've learned from them the hard way. But the good news is, you don't have to. By understanding these common pitfalls and taking steps to avoid them, you can set yourself up for success in the exciting world of investing. Thanks for watching, and I'll see you in the next one.